Welcome to the Daily Update, where I'll go over the action in the market for Wednesday, April 12th, and then we'll see how things look for Thursday, April 13th. We had a really interesting day in the fact that we knew CPI was coming out, and initial and even after the report came out, there was positive reaction to that. But then the FOMC meeting minutes came out, and there was negative reaction to that, so it made it a pretty choppy day overall. Before I get started in the video, just a couple of notes. From April 22nd through May 14th, I will be traveling. I intend to do the daily videos during that time. If I'm able to do that, I'll also do the weekly and intermarket analysis video and the deep dive video. All of this is still up in the air. I don't even know if I'll be able to do the daily videos, let alone some of the other ones at this point. So please be aware of that. I do have a podcast on YouTube, and there's a PDF not only for each video, but there's a PDF for each podcast if you want to follow through all the slides and charts that I use. I do have a private Facebook group that you're welcome to join. Just send me an invitation. There's a link to that in the description. I do have a poll that's currently posted that will run through this weekend, and I'll go over the results in the weekly video. I also have a question out there. Do you want me to include chapters and zooming in parts of the video to make it a little easier to view? Please let me know about that. I'm also aware of some audio issues that I have, and when I go on this trip, I'm hoping to get some equipment that I can use to make the audio a little bit better. Now, let's go back and talk about what happened. Right at the open, we had a higher open. Prices climbed above R1 at 41.21. We got all the way up to R2 at 41.34. That was the high. As the day went on, prices chopped between R2 and R1, so we were going up and then down before we fell below the daily pivot at 41.12. Then we fell below the unchanged level and we hit support at S1 at 4100. Prices then rebounded back up to R1 before declining. This is after the meeting minutes came out. We went back down below S1 and then we closed down at S2 at 4,090. We were down 0.41% on below average volume, even though it did pick up slightly. The technicals are still positive overall. We still have a few overbought conditions that we're dealing with. We worked off a number of those with the declining day. What we're watching for now is, are things going to shift? They're still positive. Are they going to shift back over to being more negative? So we'll be keeping a close eye on that because the markets are really fixated on inflation and interest rates and then any more banking information that may come out. Here's the intraday chart showing how we gapped higher at R1. We immediately went up to R2. That was the high right there. Chopped around quite a bit. There was a real tug-of-war going on between the bulls and the bears. We came down to the daily pivot. We fell below the unchanged level. It looked like we had set some pretty good support at S1. We bounced up off of that, went back positive. Then the FOMC meeting minutes came out, and it was not taken as positive, so we shot back below the daily pivot, the unchanged level, down below S1. We went down to S2, and that's where things ended up. Here's large cap growth and value showing pretty much the same thing. Here are the closing values. Growth was down a little bit less, but overall, value has been seeing some strength lately. Growth was down less with the mid caps as well as the small caps. Here's the intraday chart. Overnight, we were chopping pretty much sideways. There was a lot of waiting on the sidelines as the report was due out. Then we came into the latter part of the overnight session. Here's when the CPI came out. We initially shot up. We never saw that high during the cash session. It came back down. This is about where we opened. We bounced around, went lower, went higher, went lower, and then closed at the low. And so far, the SPY is drifting even lower in the overnight session. What are some comments that we can make? Volume increased, but it continues to be below average overall. The anchored moving average from the all-time high is still providing support. The NASDAQ and the NASDAQ 100 are still showing continued weakness. On a short-term basis, we have the stochastics and Williams percent R that are extreme positive, and those are our usual suspects whenever we go up a little bit, especially in a choppy environment. Intermediate term, we're still keeping an eye on the TTM squeeze and then our PMO study, and I have charts of all these to show you. The dollar was down and interest rates were also down. That home builders ETF negative divergence that we're seeing, it's still on the books, even though we're leaving it behind as each day goes past. We still want to be mindful of that. The 30 to the 5 is the only normal yield curve right now, and all of our other yield curves remain inverted. Sentiment is positive at 62, where it was unchanged. Our trend is positive, but with the down day, the green line did come down, so that's why I say weakening. But it's also getting stronger because we're still above that moving average. We're below 20, so it's a real trendless environment or a very weak trend if you want to look at it that way. Right now, I'm keeping our bias at mixed. Even though we had the down day, something positive happened early, then negative, and all of these are reactions to what happened. What's going to work out going forward from here? And I'm keeping our momentum currently at mixed. The economic reports that came out, we had the weekly MBA mortgage applications index that came in up 5.3%. Purchases were up 8%. Refinancing applications were unchanged. Here's the CPI, and I don't have those extra charts to show you. They haven't updated yet. As soon as they do, I will include those probably in tomorrow's video. But CPI was up 0.1% month over month, less than the 0.3% that they had expected and down from the 0.4% that we saw last time. Core CPI, which is when you take out food and energy, it was up 0.4% as expected and ticked down from 0.5% last time. And you can see that the market's really getting into this because they're getting deeper into the CPI report. It used to be they just gave us the headline number. Then later on, the core number became important. Now we're starting to look inside even a little bit more. Services inflation was up 0.3% month over month. That dropped from 0.5%. On a year-over-year basis, it came in at 7.3%, where last time it was at 7.6%. When you take out shelter, the services inflation was flat. Last time it was up 0.1%. That works out to 6.1% on a year-over-year basis, where last time it came in at a 6.9% year-over-year basis. When we take total CPI together, it came in at 5% year-over-year. Last time it was at 6%, and that's the headline number. That's what the media likes. That's what politicians are using. That's what the Fed is using to justify what they're doing. Look at how inflation is coming down. Core CPI actually ticked up a little bit to 5.6% year-over-year, where last time it was at 5.5%. Then we had the FOMC meeting minutes that came out from 3 weeks ago. Participants agreed that inflation remains too high. Okay, tell us something we don't know. The banking problems increased economic uncertainty. Tell us something we don't know. However, all participants agreed that it was appropriate to raise rates even though the outlook included a mild recession. That's what the market picked up on. Starting later this year due to the potential economic effects of the recent banking sector developments. That's what they didn't like, and what we've been watching for already. Looking at some Isabel Net charts. At Bank of America, they've added $130 billion to bonds over the past 3 quarters, and bonds are doing relatively well right now. Here's a technical chart. This pretty much mimics the weekly chart that I show, where we're still above this declining trend line. Here are some different support and resistance areas. And this green line is the 200-week moving average. As long as we're above that, the longer-term uptrend is still intact. This chart just suggests that U.S. commercial banks can't survive with the current Fed funds rate. In red here, you have U.S. commercial banks and savings institutions' interest income from assets that they're earning, and it's lower than the current Fed funds rate, so that could pose some problems. This just shows the S&P 500 recession troughs, or when they hit a bottom. They occur close to inflections in economic growth data. These are the months between the S&P 500 recession bottom, not only in the S&P, but a bottom in the ISM Manufacturing Index. This looks at a seasonally adjusted look at earnings, and they're bouncing higher in the first quarter, while the consensus has them flat. Here's the Deutsche Bank forecast. They're pretty optimistic, where the consensus overall is that earnings will be flat. If we look at the reality of the situation, they're actually continuing to go down. Here's the ISM Manufacturing PMI against non-farm payrolls. We had jobs coming in at up 311,000, and the ISM is at 46.3. This is continuing to decline. Will that drive employment down with it? This chart was put out before we got the latest report, PPI services and CPI services, how they had really been going up. because most of the U.S. economy now is service-oriented. We don't make things anymore. Now we just do things and then make money by selling our services, where it's continuing to come down. Here's the ISM non-manufacturing prices paid, which is also continuing to fall. This chart addresses a very interesting dilemma when you get into the stock market. Volatility is the toll we pay to invest. These are all the different things that can happen on our way to having a nice growing portfolio, or trying to earn income, or doing short-term investing, whatever you may do. Some see volatility as a negative, where others see it as an opportunity. Here's a historical chart still suggesting that we're in an overall secular bull market. Looking at some different charts that I ran across, this came out before the CPI did, showing that the short positions in the S&P 500 E-mini futures, they're at the highest level since 2011. That means a lot of folks are betting on the market going down. Well, when it gets really extreme the way it is now, sometimes that means that we've hit a bottom. This also is saying pretty much the same thing, saying that hedge funds currently sitting with largest net short position of S&P 500 futures going back to 2011. When we get to an extreme negative reading, a lot of times that marks a bottom as well. This chart just shows the Treasury and agency securities, mortgage-backed securities, and how they're really going down overall. This was a large part of what fed into the 2008 financial crisis. And then if you look at this more on a detrended basis, mortgage-backed securities that are held by banks are really going down. They're seen as risky assets. One thing that is interesting that kind of gets left off to the side is that even though the employment situation is doing quite well, there's a lot of people that have more than one job. The dark blue line shows people that have multiple jobs. And then the light blue line says they have a primary full-time job with a secondary part-time job, and that continues to really go up. Then this is kind of interesting, going back about a year and the different events and then what came out during that time. When we were really going up, Jim Cramer, who I think is a total buffoon and a rodeo clown, but people love to watch him, he came out and declared that the bear market is over, and look what happened after that. Jamie Dimon, who's supposed to be very knowledgeable and the rock star when it comes to the markets, this is when he declared that we're going into an economic hurricane, and look what happened after that. Then, late last summer, this idea of a soft landing where interest rates can start to come down without us hitting a recession, that came into vogue. Look what happened after that. As Europe was trying to figure out what they were going to do with their energy, we started going back up. Then we had some difficulties in the late fall. They call this a Lehman moment, and then the market went back up. When the Fed came out and said, we're going to have to keep rates higher for longer, well, we didn't really tank all that much. We did fall down a little bit. Now you have artificial intelligence coming out with ChatGPT 3 and 4, which is supposed to be really innovative and spark a lot of new investment and new companies. Well, we declined after that. And then we hit the regional banking crisis and we've gone up. Now we're being told there will be a mild recession. What will the market do? Well, so far the market has done the opposite of what you would think would happen. Tom McClellan had an interesting chart that he posted on Twitter. This red line is what we call the euro dollar. Now that doesn't mean the euro that's also compared to dollars. These are U.S. dollars that are deposited outside of the U.S. and they're used to do transactions. What he did on this chart is he shifted it forward 10 months, and after topping out, it's starting to come back down. We can also use the euro dollar to get ahead on what's happening with the Fed funds rate since they really fall closely. We compare that as well to the 2-year Treasury note where it's been going up, now it's been coming down. If the euro dollar is continuing to go down, does that mean that the 2-year yield will also continue to decline? This is the chart that I have where I'm not shifting anything forward or backward. The green line is the 2-year Treasury yield and how it's been going up and then starting to come back down, and then we have the euro dollar in red. I usually don't show this chart, but I wanted to compare what I have to what Tom McClellan posted. Here's another chart showing the S&P 500 and then how are people feeling about the market. They tend to react to what the market does, so it's not surprising when we're going up, they're feeling better. When we're going down, they're feeling worse. Then Edward Yardeni had a couple of interesting charts. We have the S&P, which is in red, and then he subtracts the 200-day moving average, so it dances along the zero line. We call that a detrended indicator, and how it's still been above its 200-day moving average. Then we have the Citigroup Economic Surprise Index, which is in blue, and that's starting to come back down after it had been going up. Just to give you a comparison, usually when we're surprised to the upside, that's more positive. When we're surprised to the downside, that's more negative. This is the S&P 500 forward-looking PE ratio that I show every week, how it's been going up, and then comparing it to the economic surprise index, which has been coming down. So we're seeing a little bit of a disconnect currently. Then he also had the latest reading of the Investors Intelligent Bulls minus the Bears were pretty much neutral. And here's the AAII ratio. The individual investors, after going extreme negative, they've been bouncing up and feeling better as well. Here's the chart that I have of this showing that we're getting back up. We're still below zero, but we're showing a lot of improvement as the market has been going up. What I'm keeping a close eye on too is this red moving average where it got to a real low reading, and that could give some support to the market if we decide to go higher. Looking at our charts, the Ulcer Index still suggesting there's a lot of complacency and not a lot of fear. Here's the VIX. Even with the down day, it ticked up slightly on the line chart, and we're still below 20 with the bar chart. Here's the VIX of the VIX, where volatility did spike up just a little bit. Here's the equity put call ratio. It came back up slightly with the down day. Typically, when this falls, that gives support to stocks. Another fear gauge did tick up slightly in Wednesday's session. Here's another look where fear is decreasing slightly, and we're still seeing a pretty strong indication that folks are maintaining a risk-off environment. As bonds are getting more attractive with yields going up, people are saying, forget the stock market. I want to go into the bond market and know at least I'm getting a certain return that I can count on. And so this ratio has been coming down as folks are getting into bonds as they're getting out of stocks. Looking at our trend, the green line did come down a little bit, so that's why I say it's weakening. But on the bottom, the ADX is above the moving average, so that's why I say the indicator is strengthening, but the green line is weakening. We're seeing the red line turning back up slightly. And the Arun haven't shown that for a few days. It's actually picking up a lot of this positive movement as of late. The oscillator is going up, showing that buyers are in control as sellers are decreasing. Here's the daily chart, and I tried to change this to make it look a little darker. I hope it looks a little better when you're watching the video. It still looks like we might be putting in some kind of a double top right here. We went up and hit that upper resistance and then came down from that. Can we break back above this level, get back up to the underside of this upward sloping trend line, and then about that time, this resistance coming over here might also come into play to produce some pretty significant overhead resistance. If we continue to fall, we're still above the 50-period moving average, so we'd be watching that level. Then on the bottom, you can see where volume did tick up, it still remains below average. This is the only oscillator that's giving us a little trouble right now. It's the slope, and it's our fastest moving oscillator. It's starting to cross over negative, where all of the other oscillators have not done that yet. This is a new chart. This takes the PPO, one of our oscillators, and then has a long-term study on this, and we're just getting ready to cross back above the zero line. Then we have an intermediate term study, which is above the zero line, showing it's more positive. Short term, we're showing some weakness, but if we see prices continue to go up, this could easily turn back up. So in one chart, this gives us the short, intermediate, and long-term look at the market overall. Williams percent R, still extreme positive, even though it ticked down. The stochastic, short term, extreme but declining. Intermediate term, still extreme, declining a little bit. We're starting to roll over, but we're still extreme with the long-term stochastic. The force index declined slightly, but is still positive. We're still above all the plotted moving averages. We still have dots underneath with the parabolic SAR. The Swindle Trading Oscillator turned up slightly based on price, but we're still declining based on volume, so we're seeing a little bit of a divergence there. The Vortex actually ticked up with the green line, but it also increased with the red line, but it's still positive overall. The S&P still continues to underperform utilities. In a good, healthy environment, we would see this ratio really going up, and it's actually continuing to decline. Ichimoku Cloud, we still have potential support if prices continue to fall. The PMO study, after being extreme, has now worked back down. We're still extreme positive with the buy signals, and we continue to show improvement with the PMOs that are above zero. The BPI actually ticked up a little bit. It got the early part of the action and then didn't do anything after that. So this is still positive and advancing. And the NYSE BPI also ticked up slightly. Shaken money flow, even though it declined, is still positive overall. And we were getting pretty extreme with these two green bars here. So to have it pull back is not really surprising. Balance of power was pretty much flat to slightly declining, but still above the dashed line, so that's positive. We have a second blue bar now for the TTM squeeze after giving us a pretty high reading overall. The go, no go remains positive. We're still above this anchored moving average going back to the all-time high. We haven't even touched that support level, at least in Wednesday's session. And here's another look at that as well, showing that support is continuing to hold so far. Looking at the short-term fib levels, and I tried to put the numbers on here. Please keep in mind that I draw these lines on here myself, and if you move them just a nano of an inch, it changes all of these numbers over here. So don't look at these as being totally exact. They're more ballpark figures. If we continue to go up, we've been hitting some resistance at this 41.23 level. If we continue to fall, we're looking at about the 4,009 level. You could take that all the way down to the 4,000 level-ish or so. Our longer-term fib chart has upper resistance at 41.56. If we continue to fall, I rounded this up to 4,000 for support. Longer term, we have overhead resistance at 42.14, and then we also have support at the 40.20 level. And the equal weight index continues to underperform the S&P 500 big index, which is also shown in this chart where we spiked up showing the big stocks were doing well. It's now been coming back down, which could improve the equal weight index, but we need to see more than what we've already seen. The elder impulse for the S&P remains neutral. The McClellan oscillator is no longer extreme positive, and the NYSE McClellan oscillator is also declining, but still positive overall. The summation index based on price and volume continue to advance. That's positive. We're still seeing a little bit of a divergence in this chart, which is kind of a new take on Dow theory, where you have the S&P above. We're still above this blue line, but we're looking at this double top on the bottom as we see more weakness in the NASDAQ. This is another chart that I look at every day but don't show because it can be a bit misleading. It says when the transports underperform the Dow, this can sometimes lead to weakness over the long term. The Dow is the black line, and when the red line is above, that means the transports are doing quite well. Well, then when you see the transports dropping below, sometimes that points to weakness, but sometimes it does not. So that's why I don't show this chart all that much. Currently, we are seeing where the transports are underperforming. We just want to be aware of that. We don't make decisions based on this chart. We just tuck that into our knowledge base. Then looking at the new highs, new lows, we're rolling over a bit with our 5 period, and we turned flat with the 10 period. The advanced decline line did tick down slightly based on price and volume, and we're still seeing this negative divergence overall. The NYSE advanced decline line is still looking fairly healthy. The advanced decline ratio, even though it ticked down, we're still above 0. Accumulation distribution also rolled over a bit, but we're still above an advancing moving average. Volume continues to drop off, even though it picked up slightly in Wednesday's session. The money flow index is still above 50. On-balance volume did decline, but we're above this advancing moving average. The KG chart is still pointing up. The financials are showing a little bit of improvement here, but we've seen a recent death cross with this ratio. And then looking at the regional ETF compared to the financial sector, it's still showing weakness. Broader range, the NYSE, we ticked down a little bit, but we're still above this moving average. The S&P is still above the moving average, even though it declined. The mid caps turned down as well. And then the small caps still cannot seem to break through this moving average. That's a little bit of a concern and a negative divergence. The Dow is still above its 50-period moving average, and the diamonds remain neutral. The NASDAQ, we're still watching these two highs right here to see if this is some kind of a short to intermediate term double top. The NASDAQ has been displaying pretty much weakness across the board so far this week. And the NASDAQ 100, after breaking out, we hit some type of resistance and we're starting to fall back. The Qs have now switched over to negative. On this chart of the NASDAQ 100 Fibonacci retracement levels, I've also tried to add the numbers in here to make them a little easier to see. If we start really going up, we're looking at 13,614 for resistance. If we continue to fall, we're at 12,864. And actually, we closed just a little bit below that now. This is also a chart I've been showing for a few days. This is a weekly chart of the NASDAQ 100 is represented by the Qs. We came right up to this moving average going back to the all-time high, and we've hit that resistance level and so far have been backing down from that. The micro caps were down almost 1% but have not set a new 52-week low. The small caps were down where they had been seeing a little bit of improvement. Here's the Russell, showing that we're right on 50 with the RSI, but the MACD continues to go up. The mid-caps have now switched over to neutral, and the small cap ratio, which has really been showing a lot of weakness, did recover just a little bit, but we're getting ready to see a death cross with this ratio. The mid-caps, after getting above this pivot level, have now dropped down below it. However, we're still above the 200-day moving average. The mid-caps have switched from being positive over to neutral. And the home builders, we had this extreme reading, and we're still watching this, even though it's showing a lot of improvement overall. The further away we get from this, the less likely this will play out as a negative divergence. The Copic curve remains on a buy signal, even though it's starting to roll over. The Prime bottom fisher also is giving us a buy signal. The 10-year bond, the yield was actually down slightly, where bond prices were up slightly. Looking at our long-term trend, this is a weekly chart, seeing if when we broke above this trend line, is that legitimate? Can we take it seriously? So far we can. Even with the weakness that we've seen, the MACD is above zero and advancing, and also above the moving average. If we really start to fall from here, we're going to be watching this level overall, and we'll also be watching this MACD. An update of our possible positive scenarios. This is a new chart that I showed yesterday, so this is already a signal that we're seeing. It's the ZWAG NYSE breadth thrust, where we had seen a reading at 0.4, and then it started to shoot up, and within 10 days, it got to a reading of 0.615. That's a valid signal, and this is a signal that often happens at the beginning of bull markets. This is the same chart, just showing when this indicator has triggered a signal and then the returns going forward from that point. We're still a little bit concerned here. When we take the Amex, the NASDAQ, and the NYSE, then we measure their 5-period moving average of their new highs minus their lows. We're still below zero overall. So broader in the market, we're still showing some weakness. The Qs are dropping below the moving average compared to the S&P. Discretionary is also starting to show some weakness, and large cap growth is beginning to drop below large cap value on a ratio basis. With the growth value ratios, the large caps are rolling over a bit, the mid caps are under the moving average, and we're pretty much on the moving average with the small caps. The 50-period exponential moving average of new highs minus the new lows, we're still above zero. Longer term, that's positive. Here's the indicator. It's still above this zero line. And the 2-year Treasury yield, after spiking up and coming down, it's now going back up slightly. Can that give some support to stocks if this continues to fall? And then our staples to S&P 500 ratio, we're still trying to figure out if this is a valid spike to work from. The problem with this is you can look back in history and go, oh yeah, that spike, that spike. At the time that this is happening, you don't know which one of these spikes is legitimate. So that's why we need a little bit of retrospect to get some context as to what's legitimate and what's not. And that's why I have a bunch of question marks on here. We can look at this a year from now and go, oh yeah, I would have done this, I would have done that. But seeing it played out under real-time conditions is often quite different. All right, what's our outlook for Thursday? We do have retail sales coming out on Friday. Earnings season is coming up with the banks being the first to report. The technicals are positive, and I'm still calling this where we're working off being overbought. We have the PPI coming out on Thursday, as well as weekly jobless claims, and then the whole list of geopolitical events. Barring something really wacko happening, the markets are still fixated on inflation and interest rates, and then anything that seems to come out of the Fed. And also wondering, is there going to be more banking news that comes out? We do have one scheduled speech coming up on Friday. That'll be before the market opens. Looking at the Stock Traders Almanac statistics for April 13th, the Dow is neutral to positive, being up a little more than half the time. The S&P is more positive, being up 61.9% of the time, and the NASDAQ's even more positive, being up 71.4%. So we'll have to see if historically this can help Thursday to be a positive day, where we do tend to have a positive April. And then here's all the yearly backdrop that we're using for our positive stance. We really pay more attention to this when the market's going up and showing some strength. Here's the chart that we're supposed to be going through right now, the green line, which is showing positive seasonality, as is the next chart with the gray line. And then the next gray line chart is also showing where things historically have been positive during this time. And I'm still mixed up on which trading day it is. We tend to be a little bit more positive if we're looking at the green dashed line. So our scenarios, can't really go with the down one unless you're ultra sure that we're going to head lower. Our charts are still pointing up, and if we do fall back at this point, it looks like we're just working off being overbought. But it's hard to go with the positive one with the green line on the ADX now coming down, and we're not really trending all that strong. So the ADX continues to strengthen. It's above the moving average, but it's still below 20. The green line is on top, so we're positive, but it did decline, so it is showing a little bit of short-term weakness. The warning signs, volume still is below average. The S&P is still overbought, even though it's working off some of that. The VIX is still showing a lot of complacency. When it's low, it's time to go. The S&P is underperforming utilities in a good solid up move. We would not be seeing that. Small caps continue to underperform. They had been improving. We'll have to see if they can continue to improve on Thursday. The NASDAQ may be declining from that double top. Until we take out that double top, we have to see this as a potential threat. The home builders continue to show that negative divergence, even though we're getting further and further away. Earnings season is coming up, and the banks will be reporting first. Our conclusion, the S&P is positive and so far working off being overbought. Short-term positive and still somewhat overbought. Intermediate term, somewhat overbought. Long-term, we're still above the 200-day moving average, so we remain positive. Thank you. Hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.